हॅलो. मी लाईव्ह केलं. चेक कर. हां. A very good morning, and we'll probably wait for a couple of minutes to let everybody come in and then start the session. So I'll wait for a minute or so. Hello. Hello. हाँ. So I think let's begin. A very good morning, and I am CA Sushant Karbhari, and these are tough times for everyone. I know everybody's sitting home, but I think it's the best thing will be to utilize this in a very good manner so that we do much better, because the fact remains that we won't get such a long period of time, probably for a long period. So might as well do something good. And I appreciate the fact that the Chinchad branch of WRC of ICA has is doing incredibly well in organizing all the lectures in the past few days, and the lectures have been absolutely qualitative, and probably we have some more lined up. So request you all to join in the lecture. It's a good learning, it's a good learning phase that we will have for a lot of days going ahead till the lockdown at least comes up. We need to stay positive. That's all we can do right now, but it's a good gesture by Pimprinchard Branch to organize this entire seminar. So we'll begin in about a minute or so. I've got a PPT lined up for the next 1.5 hours, because the fact remains that you will get bored looking at a face for 1.5 hours, right? So might as well give a PPT and then explain you things. But I promise to make it absolutely wonderfully interesting for the next hour or so. What I'll also do is uh, for the Q&A, I'll try to keep 15 minutes at the end, so you can put in your Q&As in the chat box, but I won't be able to see them while the PPT is going on, because of the share screen happening. So I won't be able to see the chats and the Q&A, but I will surely get back to it in the last 15 minutes. I'll plan the entire stuff so that I can keep 15 minutes at least. I'll try to do that for the Q&A session. Uh, okay, then let's start. And the topic for today is really interesting. I'll try to do as much justice as I can. It is on analysis of financial statements from the perspective of investors and auditors. So let's go to the presentation. So I'll just switch over to share my screen right now. I hope it's audible. There will be probably a little technical errors in between or something, but everybody has to understand that fact, because it's not gonna be as smooth as it will be face to face, right? So it will be a little this, but I'm sure everybody will understand on that. Let's go to presentation point of view. All right. So I hope everyone can hear me clearly and audibly. As I said, the topic for today is analysis of financial statements from the perspective of investors and auditors. I think this is, for me, it's a very fascinating and interesting thing, and also the fact that this is an ocean. It's an entire ocean. The entire subject is like an ocean. So it's so vast, it's so huge. But in the next 1.5 hours, I will try to make it as interesting and cover many concepts, which I'm sure there will also be a lot more which will be left. But this will be an eye opener or sorts of. When after the 1 hour or so, you guys will go back. I think you will get back on a much more detailed basis afterwards. but I'll try to cover many important aspects here. So let's go to the table of contents. Now, table of contents, what does it mean? What this slide means that whatever I'm going to do in the next hour or so, this will represent it here. So next hour, what is going to be taught? I'll go one by one step. There are probably around 22 to 23 slides, which will cover the entire aspects of the entire financial analysis. And these are the table of contents that I will take in the next hour or so. Firstly, revenue from operations. I think revenue from operations is the crux of entire business, because every business lives on revenues. If there are no revenues, there won't be a business cycle. If there are no business cycle, there won't be cash flows coming in. So entirely everything depends on what the business is doing in terms of its revenue from operations, and that's really important for the fact that it goes good, and management focus with their sales and their marketing team to boost this. So I wanted to cover this important aspect as well. Now, revenue from operations, I've divided it into two aspects: quantity and quality. The quantity and quality, you will say, why is that? Revenue is revenue, right? Probably you'll get to know in the coming slides what exactly I mean by quantity and quality. Next, operating profit gross margins. Operating profit gross margin are the crux of the business, because if there are no margins, there won't be any PAT, or there won't be any profit after tax. So margins are really important to hold a business year on year and take it to growth, take it to a growth stage. Third, EBITDA and its significance on the analysis. This also is again a little related to margins and operating margins, but a very important concept going ahead and in the times to come. Now, analysis of finance cost and its linkage to balancing. Finance cost is also important for the factor that it's a fixed cost, and you may have heard lots of companies defaulting on their loans, defaulting on their interest payments. And why is this important aspect? I've tried to cover as much as possible in the slides coming ahead, and there's a case study to cover with it. So to make it as practical and interesting to everybody, I've covered it in detail there. Loans and advances given. Again, this loans and advances given is something that is on the asset side of the company. Whatever funds that are given out from the company, this is what is being analyzed by me. Cash flow from operations and free cash flows. Cash flow from operations and free cash flows are also determining the fact whether there will be sustainability in the business and the going concern goes on or not. So that's a very crux, the important issue there, and many businesses focus on keeping the cash flows alive, and we'll get into a little more detail about how this can affect businesses and how they cannot. Fund flows, again, a little different than cash flows, probably a lot different than cash flows because of the accounting standards and the accrual methods and all those complications. But this is analysis and rise and fall in balance sheet size. You'll get to understand what this is again in the slides. Again, I've covered a case study there to make it as practical and as interesting as it can be. Management analysis of company. This is not exactly financial statement analysis, but this surely is a very integral part when it comes to from the perspective of investors and auditors. I think we overlook it because it's a non-financial aspect, but it's a really important thing, and what steps to cover and what things to look into, I think that will become a little more clearer there. Again, COVID-19, we are in the times of uncertainties, and once this lockdown is going to come to an end, that's a certain, right? So whenever this comes into the lockdown comes out, what should investors do? What should auditors do? What do you think companies, which are the companies which will come out of this easily and which will take a really difficult time to come out of it? I think these are the issues and challenges in front of the entire economy. Right now it's only the healthcare, but I think after the healthcare, when everything is settled down, it's actual crux issues about what happens about the economy and the financials of every company, who sustains and who does not. So this is how the entire 1 hour looks like, and I promise to make it as practical as possible in the next 1 hour. So let's start from the first one, that is revenue from operations. So revenue from operations, firstly I'll go to quantity. Now, revenue from operations quantity is something that every business goes through. Every analyst or every auditor or every management looks into growth kitna hua hai. Last year comparison, what's the growth been? So that is what means by quantity. How much is the growth be in year on year basis, quarter on quarter basis, or whatever comparisons you do. Okay, so year on year growth in terms of increasing price to same customers and increasing price customers same price maintained. Now ideally, as per me, there are three types to increase revenue. First is same customers, you increase your price of goods, that will boost your revenue. Second, increase the base of customers and keep the price maintained, that's the second part. And third part is go on doing amalgamations and acquisitions and everything, that will invariably increase your revenue because you are taking over a company's entire business, so that will invariably increase it. So but in these three aspects, I think increasing customers same price maintained is what will give you an added advantage, because increase in price to same customers will not have a sustainability, because it's a competitive environment. You can't keep on increasing prices and expect your business to sustain and grow at the same rate. So it's important businesses that increase their customer base will surely go ahead in the times to come. Now what does quality mean? We see in quality, probably might be that many people might not have heard what exactly quality of revenue means. Quality of revenue as per me is who consists of the increase of sales. So what does it consist of? Is it outside customers? Is it related party sales? Now this related party sales is an entirely different gamut, which is the most important and crux part of the entire business while analyzing revenue from operations. So I've covered it in the next slide. I'll just brief you through that. Related party sales, sustainable increase in revenue, or one-time increase. Now one-time increase or sustainable revenue, one time increase might boost the revenue 30%, 40% CAGR basis year on year, but it's not really sustainable, right? That you can't invest in a company, or you can't go ahead and say कि इसका revenue growth बहुत है because it's a one time boost or one time revenue. It has to be year on year, it has to be sustainable, or else it won't really matter, it won't go ahead for a long time. Now increase in sales, if you see increase in sales, what do you have to compare with? Will you only compare it with year on year basis and say कि चलो increase है? But I think you can have to go a little deeper, because this is the core activity of the entire business. This is the foundation of the business. This is what the business lies on. If there's no revenue, there is nothing else going around, right? So for me it has to be analyzed and linked with trade receivables, days of receivables outstanding, because sales क्यों करते हैं? Everybody makes sales because for the fact that there has to be cash inflows generated from those sales, right? So you have to compare trade receivables and days of receivables outstanding, obviously, to know the fact whether it's really generating revenue, or it's a book entry here and it's going on and on and on year on year. Again, linkage with cash flow from operations, again the similar aspect. Sales, how long is it taking to convert into cash or generate income out of it, or is it just a sale ki entry and then you take it ahead and there's no cash coming out of it? Third, linkage with write-off as bad debts. Now this is really important, because what happens is, if you see most of the companies, they boost their sales in a way because they have to keep the analysts happy and every investor happy. So what they do is they boost revenue, and you realize after 3-4 years you will find a bad debts accumulation happening out of the sales that has been generated 2 years or 1 year back, and that's really sad, because you are just temporary or short term trying to show revenue where there is no revenue. Yes, genuine bad debts are surely there, that's business and there are going to be bad debt, but there has to be some percentage. It can't go on year and year at a higher percentage. That doesn't make really a big sense if it is happening on year basis. So again, to go ahead, revenue from operations, what should you compare rise in revenue with? Firstly, cognizance of deferred sales with operations from revenue. Deferred sales, you might know, deferred sales are something as per accounting standards. If at the year end your risk and reward, there are in days there are different nomenclatures in the accounting standard. There are now different nomenclature. But I'll just go by accounting standard nomenclature. Deferred sales are probably sales that have not happened, or the risk and reward has been transferred after the year end. So once you transfer after the year end, there is no sale as far as to say for the year. So the deferred revenue is shown in your balance sheet and not in your sales. So you have deferred sales shown there. So next year those sales are brought back in the P&L. So when that happens, you have to understand the fact whether the growth is due to the deferred sales coming back or is due to the genuine increase in the customer base happening year on year. Second, asset turnover ratio. Again, if it is an asset heavy company, why are the assets put? The assets are put in so that revenue increases. If there is no revenue increase and assets are just getting added, what is the use of it? Probably there might be capex happening, or there might be WIP happening. WIP is okay, 1 or 2 years, and it comes back and generates revenue. But finally, ultimately, in an asset heavy company, revenue should generate from those assets, right? There is no point in incurring so much of cost and not being able to generate revenues. Again, cognizance of change in accounting policy with respect to revenue and operations. Now accounting policies change. This can boost or reduce revenues for that specific year. So one has to go through again the notes of accounts and management discussion whether they are talking specifically on some revenue aspect which has impacted their financial year. If during the years there is nothing and they're silent and might as well it's okay, then the revenue is kind of genuine and sustainable. But if there's something due to the change in accounting policy, it's not going to be sustainable over a longer period of time. So that are some aspects that you need to consider in and out of everyday's analysis. For me, red flag, I think red flags are three types. One is rising sales, good; rising receivables, not good; and rising debt, not at all good. So that means you're increasing your sales, you're not generating cash out of it, and you're also taking in debt because you have a shortage in working capital or shortage to fulfill your goals and your targets. So that is something that you should consider while analyzing companies and auditing companies. And if specifically you're auditing such a company, you have to have a qualification saying there has been a red year on year happening, it's happening consistently, and this doesn't seem right from the perspective of an auditor or an analyst. Now, as I told you in the last slide, related party sales. For me, it's a really important analysis that I carry out when analyzing companies, whether the sales are genuine or whether they are not. So what you have to do is percentage increase in revenue from operations vis-a-vis increase in RPT sales. Now, what does this mean is if your sales are increasing by say 20%, 25%, your RPT is increasing more than that and contributing it's not really genuine revenue. It might just be an accommodation entry to just fulfill targets and meet analyst expectations. So deep analysis on this aspect is really important. Again, RPT is financials. Now I'm not sure if every company reports this, but I've seen Reliance Industries Limited annual report where they specifically give P&L and P&L, I think P&L and balance sheets for every subsidiary and associate of theirs to know which one is making a profit and which one is not. Now consider a situation where the holding company is making sales and boosting it, and the growth is due to the RPT sales. And the RPT, the major RPT person who's buying the subsidiary who's buying the sales from the holding company, which is listed, that RPT is incurring losses. Now, this ideally is not in the right favor for the RPT. This is just to boost revenue of the holding and carry on sales and push it to the subsidiary. So detailed analysis has to be done whether the RPT's financials are sound and or they just incurring losses due to the fact that the holding company wants to make their sales going ahead. So that is the entire there. So let's go to the case study now. Case study is really interesting one. I think I'm covering it in 2 or 3 slides, but every portion of it will give you insights about what happens with revenue operations and why you can't take it lightly and you need to do a detailed analysis. First one is, let's take a random ABC Limited. Now from the P&L statement, I'm sure if you go to the P&L statement of the company, you will get this line where it's written revenue from operations. Now if you go to the 17, 18, 18, 19 and 19, 20, there is a growth. Okay, there is a growth of revenue. You will say, acha, good company is doing really great. What is the growth? Growth is 18.75% in 18-19 and 30 odd percent in 19-20. Now that is good sustainable growth, isn't it? So let's go ahead. Let's see. It's a don't be satisfied with this and say ki chalo growth hai, so let's go and invest or do something like that. So probably have a detailed analysis on that aspect more. Again, here you can see the breakup of the growth. Now what can you infer from this? What you can infer from this is previous years the core business of the company was sale of goods. but now they are trying to deviate from their core business. Might be specific reasons, might have be business conditions or business reasons, no doubt about it. It can be genuine, but they are trying to divert it and do more of revenue from services. Now what does this does is this changes the business mix. This changes the sales mix of the business, and now an analyst who knows that this is a primarily a goods company suddenly alerted, why are they doing revenue from service? Aren't they getting customers, or doesn't their product have demand? And probably you will get the answers from their management commentary in change of goals or change of objectives year on year. Now what do we infer from this? You infer from this is that percentage rise in sale of goods year on year has just been 4.2 and 12% as we saw above, and rise in revenue has been substantial, that's 62 and 65. So that is the reason the net of growth is around 30%, 30 odd percent in 1920. So everything looks good, isn't it? Everything looks good for ABC from the prima facie analysis. So any analyst or any investor इतना देख लिया thinking चलो ABC is doing quite good and let's go, it's a growth company, let's invest. But you need to look a little more deeper for the matter that there are much more hidden things that happen. Here again, disclosure or transactions with related parties. I think I told you in the previous slide, related party, what does that constitute? If you see related party also, related party sales have grown 33% and 78%. Now, this is as per the previous slide, the growth from revenue. So this consists of outsiders as well as RPTs. What this signifies above is there is a 78 crore growth out of the 115 crore or 50 crore that has happened in 1920. 78 crores has been on account of RPTs, and that is why there is a 30 odd percent growth as you saw in the previous slide. Now this may be genuine surely, but if you want to boost, say, why push it through RPTs always? You have to get a new customer, or if it has to be sustainable, you can't push every sales through RPTs, you know. So here if you see 115 out of 78 of 115, that constitutes about 60 to 70% of revenue coming from related parties. Now if you remove the effect of the growth of related parties, probably the sales growth percentage will not be 30, but will probably be 10 odd percent. So interpretation above for the above for me will be again from operations 150 crore consists of 78 crore from sale to related parties. Surely these sales might be genuine and not only to increase growth rate. But the figures on the next slide are alarming and raises red flags about whether growth rate of sales of 30% is right or wrong. So what we should do is go beyond this also as auditors and as investors, and look beyond this for some more detail, because right now the doubt is there. Doubt has arisen, but a doubt is genuine or not is to be validated. So you can validate it by going ahead. So what do we have ahead here? What do we have ahead? Here we have balance sheet of ABC. Now balance sheet of ABC, in their current assets, you can see trade receivables, which is 50, 80 and 130 crores. Now here you can see rising trade receivable. That's okay because there are rising sales. So rising trade receivables can happen, and probably trade receivables ratio, sales ratio or days of sales outstanding can give you better picture about whether it's a trend rising or not. But what do we have in detail on that? Trade receivables from related parties is also rising. And it's just not rising, it's rising more than double. Now this creates a red flag because there has been an increase in sales to RPTs, but those sales are not generating revenue. Now nobody does sales just to make the investors happy or books of accounts mein dalne ke liye, right? You have to make sales to generate revenue from it. And if that sales is not generating revenue, I think it's a red flag if it happens year on year. This trade receivables has to go reduce after a period of time. Just can't go on rising year on year and then the company is sound, because someday they'll come where they'll put a hand up and saying all the sales was not really sales, we'll restate the entire thing. So you need to be really careful, little careful when you go and see sales of this sort. Again, you can validate this from the cash flow statement. Your cash flow from operating activities for 3 years is consistently negative. There are multiple factors why it is negative, no doubt about it. But one of the factors is because RPT is not giving back the cash or the money. So what can we infer from the entire picture of 3 slides? What does the 3 slides tell us, or what does it, ask us to do while being careful with revenue from operations from next time? I think it tells us, first thing it tells us, although there is compounding growth in sales, the same seems to be an account of RPTs. As I told you before, there is growth, no doubt, there is growth, but it is RPT sales growth also. There is a substantial portion of RPT sales. Also, the increase in sales is not getting converted into cash, as is evident from negative cash flows, and also higher increase in trade receivables than sales. Finally, it has to generate cash. Year 60 days, 80 days, 120 days, 360, that depends on the business cycle. But ultimately, it has to generate cash. It can't go on not generating cash. Another red flag is slow realization of trade receivables from RPTs. Now, slow realization from customers, outside customers, is understandable. It can be genuine. But slow realization from RPTs raises two issues here. One, the RPT is not sound enough to, the financial of RPT is not sound enough to pay you back everything, or the RPT is not, the sales have not been genuine, and they are not going to come back. The money is never going to come back. Okay, also an investor may not be comfortable investing after in-depth analysis on the same. But as an auditor, you have much more controls and much more additions to do, because you have additional information. You can go in depth about what the RPT is, call for the RPT subsidiary books, everything, and you can do a lot of depth analysis that the investor analysts do not have the privilege to do. So you, after analyzing so much, I think you should spend some more time in realizing the fact what's the quality of sales, instead of just looking at quantity and saying chalo बढ़ गया तो ठीक है, it's going good. Quality of sales is a really good crux point that I think many auditors and investors should focus on to really understand whether the business is having good corporate governance, might as well doing good. Now, next, coming to operating performance analysis. Now, operating performance analysis, as I told you, is about the operating margins. The what does a business do with its operating profit? How does it generate? What's the margins? Then the entire other things depend. So here are your comparisons of operating margins to ensure no deterioration in margins. So if there are deterioration in margin, what can you infer from this? I think I can infer from this is that the margins are getting deteriorated because of the fact that competition is increasing, and that is affecting their business. That's why there is lesser demand, and over time this may not sustain and competition might kill it. So it's really important to analyze the year-on-year trend of operating margins. Also, increase in cost of materials consumed in proportion of a percentage increase in revenue. Obviously, if the cost of materials consumed goes up, your operating margin goes down, because your revenue from operations is not going high as much as the cost of materials is going high. So I divide cost of materials into three parts. Now you might say cost of materials ideally means for the manufacturing, right? But no, I put it into three aspects. One, from the perspective of manufacturers, yes, manufacturing, cost of raw material consumed plus direct cost. I think this is subjective about what cost of materials consumed consists of. It might consist of consumables, it might consist of some more aspect that are directly relational, but it depends on subject to subject, case to case basis. But majorly, I think majorly the cost of material, raw material consumed plus direct cost is equal to the manufacturing business, what cost of materials consumed is. But for a trading business, this might not be the case. But what is a trading business? Trading business entirely, it's a purchase of trading goods. That is what that's on that basis the entire margin depends, right? Whatever purchases, how much is he making at cost, and what is his margins there. For service sector, again, service sector, you don't have raw materials, right? You do not have trading goods. You have service. But what is your core cost in service? I think employee cost is one core cost, and I also like to put in cost of funds. Some people might not put in cost of funds, but for me as a service sector, two major costs are, one is employee cost and one is cost of funds. So entirely both has to come in sync, so that they give a clearer picture about what operating margins are. Inventory turnover ratio, again a very important ratio to analyze whether there is demand for the product, whether there is slow moving, non-moving inventory in picture there, and also if there is inflation and there are old moving stocks happening, what prices do they sell at? It's very important, because now during the COVID happening already, there are stock that are lying way before, so they have to be removed out. So all these factors come into the picture while talking about inventory turnover ratio. What aspect is inventory in proportion to its turnover? Now, if this ratio is stable or there is an increase, I think it's a good thing. But in declining inventory turnover ratio over number of years, comparison should raise a red flag. one odd year, 2 odd years, I can understand it's all good. But year on year, if this ratio is going down, there's something wrong with the business. There's something wrong that the management and the business is not doing right. So this is one of the, again, one important aspect where you can analyze the fact what's happening, really happening with their ratios and what's happening with their inventories. Some more detail in operating performance analysis, because of the fact that it's a really important aspect to the entire analysis part. Uh, what I have seen is some of the companies, it's not a recurring point, probably it might happen a year or two, but if you determine raw material cost and direct cost as your operating cost, right? Sometimes the indirect costs sometimes creep into the top line, and then change the operating margins, or sometimes the top line costs go down indirect, and then that changes the margin. So you have to be very careful in reading between the lines in the annual report or the financials to know the fact that there is no accounting policy change, or there is no reclassification of expenses to inflate or reduce operating margin as per the expectations of the industry and expectation of the market. So this is important, because you might seeing a consistent operating margin, but this might not be, because there might be some classification happening, but not sustainable. It won't really last you for long doing that. Now, as I told you, EBITDA is earnings before interest and depreciation and tax, obviously. But on a personal level, as I've written it here, when I analyze companies' financials, EBITDA is a much better ratio for analysis of profitability than PAT. Obviously, after thorough analysis, PAT, people or investors focus on too much on net profit. Net profit kitna hua? Mera kitna? What is my EPS? What is my net profit? How much is the company making? That is important, no doubt. That is important, because finally, you, as a shareholder or as a investor or as auditors, you have to certify saying net profit and everything. But EBITDA is something that's an offline ratio that doesn't come in your financials, whereas net profit and PAT ratio, it comes right on the financials. EBITDA is something that gives you a much better picture personally. Probably I'll explain it in the next slide why I mean that, but I think EBITDA analysis should surely be done to check out the operating performance analysis. What is EBITDA? It calculates the surplus after the operating cost and also the indirect cost. So this takes into consideration not only the operating cost, as we saw before, to keep the operating margins intact, it also consists all the indirect costs. Let's take an example where we compare percentage increase in EBITDA and percentage increase in PAT with revenue of operations. Finally, what everybody now know is profit after tax, people know, revenue from operations people know. But why EBITDA is so important? In the next slide, you'll get to know why it is really important as happens. So EBITDA here, again we'll take an example, ABC Limited. Sales here, that is revenue from operations, is 100 crores, 120 crore, 140 crore. That's stunning, because they are increasing sales consistently. Obviously, we have to make analysis as per the previous slide, but let's exclude all that and let's take it on face value. Right now the sales are really good. EBITDA. Now what's the EBITDA? EBITDA is 25 crore, 33 crore, 42 crore. What's the EBITDA percentage to sales? The percentage to sales is 25, 27, 30. So you can see an EBITDA rise. Why is an EBITDA rising? EBITDA is rising because there are costs being controlled. There are multiple factors or parameters taken by the company to keep the costs in low proportion. Again, PAT and PAT percentage to sales. PAT here is 8, 9 and 10. But if you see PAT percentage to sale, the margins are dropping. So although there is an increase, but in proportion to sale, the margins are coming down. So is it good? Is it bad? What's really happening? So as an investor and auditor, will you infer that the company you're invested and auditing is doing bad? If you do not take EBITDA, I think you will consider it as good. But if you consider EBITDA, probably it happens both ways, as I've written here. The answer for this is probably yes and no, both. Now, how are both the answers possible? Both the answers are possible because you have to look it from the point of view of an investor or as an auditor, as the way you're looking at. But I'll give you reasons why I think that it is bad and it's not bad. To just refresh, what we are looking at here is EBITDA percentage rising, PAT percentage falling. That's what we are looking at, whether it is bad or good. So why is it not doing bad? Okay, that means why is it doing good, right? Now EBITDA margin year on year are getting better, hence core operations and major costs are controlled. I think the entire business is built on core operations and core major costs. If those major costs are controlled, a lot of other issues get streamlined and get negated. So EBITDA margin year on year are getting better, and so core operations are getting better. Also, PAT may be lower due to higher depreciation, hence higher capex, which in turn may boost sales in the future. Now, what might have happened is EBITDA is before depreciation, interest, and taxes, right? So there might be a higher depreciation. Now, higher depreciation can happen due to higher capex. Capex is capital goods put into as expenditure. So that is fixed assets and your cap WIP. So whatever is in put in as assets and generating you revenue. So your capex in turn may boost sales in future. So it's actually good that they are putting in capex so that the higher sales can be generated for a longer time going out. So it's not that really bad, right? Also, PAT may be lower due to one-time higher taxes paid. You have to read between the lines, probably from the notes to accounts or management commentary, where they will let you know what's happened with their taxes this year, and you may come to know that PAT may be little lower due to the one-time higher taxes paid due to government regulations being changed, due to multiple factors that go in. So considering all these three, and there are obviously there might be much more reasons and for the business why it's not doing bad considering the situation. Now, why is it doing bad? Now, PAT may be lower due to increase in debt resulting into higher finance costs. Now, ideally debt increase, you have to see the reasoning for why the debt has been taken and what's the purpose of it taken. Because EBITDA is not getting reduced, but PAT is getting reduced. It has to do majorly also with finance costs. So finance cost might be rising year on year, which is not a good thing if it's not being used properly. Now, higher depreciation from non-core assets. Now, as I told you in the why is it not doing bad scenario, that the higher costs may be due to capex. Now, capex might generate revenue, but non-core assets are not generating revenue. For example, if company wants to buy vehicles for a director and is buying heavy vehicles or airplanes or helicopters for the company, it's not going to really generate revenue directly for the company. So if depreciation is an account of all such factors, I think it's not really doing good on a longer basis, and you have to be careful as auditors or investors and put on your qualifications if you've got an audit report to sign. Also, permanent increase in taxes. What might have happened is for this specific business, government might have brought in some policy saying your taxes are getting increased after a period of time from this time. So that is the reason probably this PAT might be going down, and this will continue to go down. So if there is a permanent increase, this PAT margins will go down unless and until they do something different on the finance cost and the depreciation point of view. So these are the entire thing why EBITDA is important and why you need to also consider EBITDA while analyzing PAT. So don't only analyze EBITDA, don't only analyze PAT. I think both has to be done in sync with each other so that it gives you a better holistic picture about what's happening. Now, analysis of finance cost. So what we saw right now is we saw revenue from operations, we saw EBITDA, we saw operating margins. Now, how does analysis of finance cost and its linkage to balance sheet stand? Firstly, we need to understand what finance cost is. Finance cost, again, primarily or majorly consists of two things: interest on borrowings expenses. So whatever borrowings the business is doing with consideration to the liabilities side, all the borrowing, be it short term, long term, all the borrowings. So interest on that is hit to the finance cost. Also, other borrowing costs. So other borrowing costs consists of debentures, issue of bonds. So everything that a company issues and the interest is to be paid on that, or the cost is also included in the finance cost here. So what are the important ratios or factors while analyzing auditing finance cost? So finance cost, what will you analyze? How is it? How is it getting better? Is it getting worse? What is happening with it? You can just look at a figure and say ki ha itna hai. How do you interpret it? You got to do something to interpret it, right? Firstly, what I personally do while analyzing finance costs is what is the average cost of borrowing. Now, is the cost increasing year on year? So average cost of borrowing is easy to find out. For an auditor, it's easy to find out because you have loan statements and sanction letters and everything to your disposal. But as an investor, how will you find out borrowing cost? I think for average cost of borrowing cost, you probably can find out if you calculate finance cost divided by total borrowings what they have in their balance sheet. So you'll get to know average borrowing cost. But to make it easier, some management write their average borrowing cost in some notes to accounts or management commentary, so you can directly get the average cost what they are incurring right now. So this has to be compared year on year basis. Is the cost increasing year on year, or is it getting better? Are they negotiating better with their bankers, or there is stress on their balance sheet? That's why the banks are not giving loans at a lower rate. So there are multiple factors interpreting to it. Also, again, in continuation to this, what is the debt equity ratio? Debt equity ratio, I think, is a very common ratio that most of the people analyze already. So again, it's a very important thing also. So is it getting better or worse? And if it's getting worse, how worse? I mean, it should not get over the top where after a point of time you realize the company not being able to handle its own debt. Now, one more reason what you can analyze is for what reason is the funds being raised and how is it getting utilized. So going beyond P&L and balance sheets, you got to also analyze cash flow statement where you have cash flow from financing. You will get to realize a line item there where it says that you are getting in funds, and you can also see where it's gone through. So entire cash flow statement you can come to know where it's going. Is it going paying dividends? Is going paying other stuff? So detailed analysis of cash flow statement can give you a wonderful picture about what is happening with the funds being raised and where is it going. Now, whether ROCE percentage is better than cost of borrowing. Now, what every business does is, or what every business will obviously do is, if the cost of borrowing is, say, average cost of borrowing is 11%, you want your business to generate at least 15 or 16%. If your business is generating 2% and your cost of borrowing is 10%, you will ultimately lead into death. It's going to be coming over because the costs are getting too much and you can't get over because you're not utilizing the funds as nicely as they should be generating returns from the cost of borrowing. So it's as simple as, for example, if you have funds and you realize the fact that if you put it in FD, you will probably generate 7%, and the inflation rate is, say, let's say for hypothetical situations, let's take 8%. And if you put it in 7% FDs, it's not going to generate anything. But those funds are being borrowed by you at 12%. So you have taken a loan and put it in FD. It doesn't really make sense, right? Nobody at a personal level will take such a stand saying you're borrowing at 12% and you're going to keep it your FD at 7, whereas the interest rate is already 8%. Those funds are going to be over quite soon, and it's going to create you into a lot of problems. So similarly, this for companies is ROC percentage is better than cost of borrowing or not. Again, there are multiple investors taking in multiple parameters. There is ROC, there is ROIC, there is ROE, but you have to consider whatever is appropriate while analyzing and take a call on it. Now, whether interest coverage ratio is sufficient to cover finance costs or whether the company has a risk of defaulting in the future. What does this mean is, what is interest coverage ratio? Now, interest coverage ratio is how much the entire funds do we have, surplus funds, do we have to pay off the interest, or is it getting too succumbed, or is it getting to liquid problems that is going to create problems and the company might have risk in defaulting in the future. I'll probably explain this a little better in the next slide where I have a case study in picture there. Now, analysis of finance cost and its linkage to balance sheet case study. Now we'll take a real life case study, which is financials of DMart, which is Avenue Supermarkets Limited. Now these are real actual figures which are publicly available, so it's not something that I have access to. You also have the similar access to it from the annual reports and from the quarterly statements. So this is the split up of all finance cost for the year 18-19 and 17-18. Now if you go to see here, total finance cost in the P&L for 17-18 was 59.54 crores and finance cost for 18-19 was 47.21 crores. Now you might look at this and say, wow, they are doing good with their debt. A company which is reducing their finance cost is increasing their margins, PAT margins, and increasing a lot of rolling a little eyeballs to have focus on them. Let's look a little deeper into the financials by comparing this finance cost with both the long term and the short term debt in their balance sheets. So this is again the specific balance sheet annexure, but I've compiled it from various schedules from the notes to accounts. So here you can see for 17-18 the borrowings are 439.25 crores and for 18-19 it is 700 crores. Now you might say the debt has gone up by say 200 to 300 crore, but the finance cost has gone down by 12 to 13 crores. Now I interpreted the same thing. I said, how is this possible? There has to be some catch to it, or there has to be some explanation given to it, because ideally 99% case ratios, if the debt is increasing, the finance cost will go up. If it's not happening, probably something is somewhere going wrong with the picture, or there might be specific real reasonings to it. So let's see on the next slide what exactly were the reasonings to it. Like I said, how can borrowings outstanding in the balance sheets as on 31/3/19 increase, whereas the finance costs go down on year-on-year basis? Now, if we dig deeper into the financials and communications of DMART, now communications of DMART also means what they communicate to the investors or their conference calls, what they speak and what they specify. That shows where they are leading into going into the future. Firstly, what I analyzed was increase was on account of commercial papers and term loans from banks. So this increase was due to these two factors. Then what I realized was commercial papers were issued in March 19. So that is right at the fag end of the year. Now what this signifies is the entire effect of the finance cost or the interest on these commercial papers is not going to be accounted in 18-19. This will be accounted mostly in 19-20. Also, the term loan which has been issued with a moratorium of 6 months. So, as per the their conditions or the sanction letters which they had publicly announced, it had a moratorium of 6 months. Again, what this infers is, although the finance cost for 18-19 was lower, the finance costs are ought to go up in 19-20. As an investor, if these costs are huge, it plays a part in the profitability and decision making. Obviously, looking at only one financials and not looking beyond the picture or looking at something beyond it, you can infer only कि finance cost is going good, controlled है, सब चल रहा है, चल ठीक चल रहा है, let's invest. But the factor here is in 19-20, if you go to the current year, this finance cost until repaid easily or repaid quickly, this finance cost will jump up surely from 18-19 figures or from 17-18 figures. And this is what as a investor you got to make decisions. Where are the costs coming from? Are they going to be incurred now, or there is some to be incurred later on also? So I have put in this interest coverage ratio for DMART. Again, interest coverage ratio for me is EBIT divided by finance cost, because I take the effect of depreciation. Because for me, depreciation might be a non-cash expense, but it's also a real cost that the company incurs over a longer period of time. So some people take EBITDA divided by finance cost, but I think EBIT will be a much more better ratio to prove whether there is interest coverage with the company. Now this ratio, what does this ratio say? This ratio provides a cushion during bad economic times, and the company would not find it difficult to service its debt even during bad times. So ratio of 3 is ideal. Obviously it will differ sector wise. 3 is probably one standard which is there, but sector to sector depends on the business cycle and all those parameters. Now how does it look for DMART? For DMART, interest coverage or ratio for DMART is 31.12 times. Means DMART has rupees 31 to pay a debt of rupees 1, which is way beyond the comfortable, evidencing no stress on the financials with respect to debt repayment. So at least considering debt, you don't have to worry, because of the fact that there is enough interest coverage ratio, there is enough resources there to pay off the debt. Consequently, this is like a two sides of the same coin, where you have a debt equity ratio and the interest coverage ratio. So both are playing important roles. So your debt equity ratio obviously has to be lower, probably 99% cases where the interest coverage ratio is pretty sufficient. So that was a part as to where I came for the finance cost and everything. Now let's go to the important thing where there is loans and advances given. That is asset. Now we saw in the previous slide what borrowings are and what finance costs have to deal with it. Now what are these loans and advances given? What do they signify actually? Now one of the critical aspects, but probably mostly ignored by most auditors and investors, because most auditors and investors focus on revenue, PAT and sales kitna hua, profit kitna and everything. But you have to also understand what is happening with the balance sheet. It's not the P&L that will sustain you for a long period of time. It's strong balance sheets that will sustain you in the period of crisis. So I've divided it into two parts. One is long-term loans and advances. this consists of capital advances. So capital advances is something that you are taking into, you have given it for fixed asset purchase or purchase of longer nature. So if those advances are given, and what is that comprise of in your balance sheet. Also security deposits. Now mandatory, some companies have to surely keep some security deposits with some companies like electricity board or many more mandatory compliances, where they have to keep it for years and years and years. So that was classified under long term advances. It's a normal business process, nothing as a red flag or something. It's a normal business process. The third one is loans and advances to related parties. Now this comes into the picture very carefully. Again, we saw as sales. I think the second parameter where related parties are really important is loans and advances to related parties. Why? I'll let you know in the next slide why these are important, but these are really important while considering the fact that to whom you are giving the money. Other loan and advances which are not to related but to outsiders and all such aspects. Now second one is short-term loans and advances. Short-term loans and advances consists of again three parts, except for related, I think I have not taken capital advances because they are long-term. All these three aspects are again covered in short-term advances. So as an investor, what are the parameters to check? So what will you check? If you find the amount in the balance sheet looking in the assets saying long-term advances, or in your current or long-term assets as loans and advances given, what do you need to check or what do you need to keep in mind? I think this slide is of absolute wonderful importance because I use these parameters so n number of time while auditing and also while analyzing companies, and it talks a lot about the depth of how much this can play a role in bringing down the company or taking the company up. So I've divided into two aspects. One is two broad analysis or risk emerges. One is, see, it's normal. Now tomorrow you give your money to your friend or to your family member or anybody, and you have two things you expect that money to do. First, you expect that money to come back. At least the principal should come back. So while giving up money to at least friend, not to family members, but to friends or the other outsiders, you expect that money to come back, right? So first is risk of non-recoverability. Now this related party lending has to be compared year on year with recovery. So when the money is given, is it coming back? So recovery, where you can come to know from reducing outstanding balance. So if the related party already has balances in picture and you're still giving them money without the balances reducing, that's probably a red flag. Why does the related party require so much of loans and advances, and does the company have surplus to give it? देते जा रहा है, हर साल उन साल बढ़ते जा रहा है. So you have to keep that in mind. Also write-offs in P&L. I think this is a very important issue. Why? Because money is given, okay, 3 years money is given, and suddenly you find a write-off of that money because that money is lost. Now, if this is happening with related party, I think it's one of the biggest red flags that happens. One-off transaction I can understand, 1 odd year I can understand. If it is happening consistently, you need to catch hold of the management and ask why are you even giving money if they are not going to be paying back. And if it's happening with the same party, I think it's much better to come out of the company rather than to wait and see the company falling before your eyes, because it's not good corporate governance. Second, sources of funds. Now, what does sources of funds mean? Ideally, lending is desired when a company has excess funds. Now, if a company doesn't have excess funds, why will you lend? Like for example, if you do not have excess money, why will you give it to your friend? You will not take a loan and give it to your friend, right? You will obviously have excess with you, and that is why you're giving. So if a company does not have excess and it's still lending to related parties and outsiders, you have to just look at the cash flow and saying it's in a negative and still giving. What's the purpose of this? Second is lending is a no-no in most cases when there are negative operating cash flows. Operating cash flows are negative and still you're giving. That doesn't sound or look good in a lot of aspects. Again, capex has been undertaken by a company out of limited funds. Company might have in their goals or statements specified we want to expand in the coming future and 10 more things, and for that they require a lot of capex, right? But you can see they have a stress in their financial cash flows where they are using that cash flows to put into capex very safely or very thoughtfully. And then you see one figure where you see loans and advances given to related party. How does it make sense when you are still saving money to put in your capex and then also utilizing it to give? It doesn't give a good picture there. Also, borrowings are increasing year on year. Now, as I told you, if you have excess funds, you will give it to your friend, right? You will never borrow from a bank and give it to your friend. If it is of a lower interest cost, you will never give it to your friend, right? Similarly, if the borrowings are increasing here, it does not make sense to give those money out. That borrowings are for the business, right? They're used to be used for the business, not to give to related parties or as advances to others. The second aspect I told you is risk of idle assets not generating any return. Now, when you give money to your friend, you expect most of the time you expect some return out of it. So, like you give 1,000 rupee, you expect at least 10% to come after a year. So that's 110, 1,010, 1,100 rupees coming back. So similarly, you have to consider when loans and advances given. Firstly, risk of recoverability, principal should come back surely. Also, if what are those assets generating? What are the loans generating to the business? Because it's not free money, right? It's shareholders' money you're going to put in. If you had put in the business, it might have given you probably more return. But you're giving it out. There has to be justification for giving it out to related parties. So what will you compare with? So the money given has to at least generate the company's ROC. Now, why is this important? If you had kept the money with yourself, you would probably have generated 12% odd, for example, 12% odd ROC. Now, when you are giving out the money, you expect at least 12.5 or 13%. If you are or 12% to say the least. If you are generating 10%, why give it? Might as well put in the business and generate a higher ROC and use the funds. Also, if not the ROC, at least equivalent to bank FD rates. Bank FD rates, if you had put that money in the FD, probably you would have got 7.5 odd percent. So giving it to related parties and not generating or generating lesser returns than that doesn't play a lot of sense there, right? Third is, so these are the two aspects with respect to not generating return. So if a company is giving out loan and advances, you have to compare the other, you have to compare the P&L statement of other income, where you come to realize how much the company is generated from its loans and advances. If the primary business of company is not lending loans, if it is lending loans, then you can probably see it in revenue from operations. But if it is the business is not generating loans, it will come in your other income. So what areas to check to entirely understand the entire aspect? Firstly, comparison of current assets and non-current assets, as the case may be, to check where the principal amount is it increasing or not. Second, related party transaction disclosure to see whether year on year the loans given are increasing. Third, cash flow from financing activities, again to understand the fact whether borrowings are increasing and the same is being funded to related parties. And fourth, as I already specified, other income in P&L to check whether those loans and advances are giving you some returns more than whatever I specified above. Now, cash flow from operations and free cash flows. Now, this entire 2 slides or 3 slide is my favorite, because cash flow from operations gives you an entirety about what the business is doing. P&L balance sheets can still be right, no doubt about it. Cash cannot be faked. You can't fake, 99% cases you can't fake cash coming into the business or not, unless and until you're reporting absurd figures entirely. But 99% you can't really go wrong in judging whether cash flow is coming right or not. So a wonderful quote I would like to say by a world-renowned investor: people focus too much on P&Ls and balance sheet, but cash flow statement is where the real deal is. And if you have been analyzing companies or auditing companies, I think it's much important to compare and reflect balance sheets and P&Ls with cash flow statement, and not only do it uniformly. You need to compare the entire three aspects and take into consideration what does it mean for the person reading it. Now let us see why cash flow statements are dealt as being so important, and why do I treat it as a favorite part of my entire presentation. Now, for a specific year, PAT and cash flows from operations will vary. But for a long span of say 5 or 10 years, they should reconcile and be close to same. Now, what does this mean? Okay, this means, now what PAT, what it is profit after tax. So everything that has gone in your P&L is your profit after tax. Now everything in your P&L, PAT comes from accounting standards and a lot of provisions and a lot of accounting entries. So it's not entirely everything that you pay in cash is not in your P&L. So there might be something you have not paid, but they're still in your P&L, which you might pay later. So PAT for this year, all the items in your P&L are to be paid in cash or received in cash in this year or subsequently. Now, if they are received in this year, it will reflect in your cash flow from operations. But if they are not received in this year, they probably differ from the cash flow from operations. But over a period of time, over say 5 years, 10 years, PAT and cash flow from operations should be same, because everything that is for this year in this P&L will be paid 1 year, 2 year, 3 year, what at some point of time. If getting paid, that's a red flag saying why isn't the CFO and the PAT not matching even after 5-6 years? Are there some items just were there just for P&L and did not generate cash out of it? So it's really important to see over a long period of time what PAT and cash flow from operations do. So in short, cumulative PAT over years versus cumulative cash flow from operations should be absolutely same. That for me will give me a conformity saying that business is doing good, they are generating, and there does not seem to be any gimmicks going on with the business. Now, companies that are sound financially and have generated wealth for a long period of time for investors have one thing in common. And I think this one thing is very, very important, and we should see for every companies is cash flow from operations has to always be more than requirements of investment plus repayment of debt. So if you have investment lined up and you have to repay debt, whatever amount you have to pay, that has to be lower than what you're generating from your core business. If that is happening consistently over a period of time, I see no reason why the company should not be doing good and should not generate wealth for the investors. Obviously, there are many parameters also, but one crux will be to see this, and it generally won't go wrong in many of the cases. Then you can see the title, there are free cash flows. Now, if you say this is cash flow, okay, this I understood, but what does free cash flows mean then? What is the difference, or what does really it actually means? Now, free cash flows for me means cash flow from operations minus capex. So whatever capital expenditure that the business has incurred, that has to be reduced from cash flow from operation to give you what are the free cash flows happening. What is capex? Now, capex will be calculated ideally by gross fixed assets plus cap WIP of the year closing, both closing, minus gross fixed asset plus cap WIP of the opening. So this gives you the entirety net increase in your capex for the year. So that is the entire increase in capex. So this has to be reduced from cash flow from operation to give you a picture as to what is the core free cash flows remaining with the business. Now, what is the significance of capex being deducted from CFO, and why is this important? Now, you might say, ऊपर के slide में था cumulative and everything should go right and everything. I understand everything is good, but then why capex? Why not some other cost that has to be deducted? What I personally feel, and I think what most of the investors, or I've read a lot of research papers where they come to a conclusion on this is, in most cases, capex is a committed cost and usually budgeted in terms of company's plans. Like if there is capex and the company is making year on year, it's making plans about expansion, the capex has to be incurred. So you can't say I will consider free cash flows without considering that cost. So that has to be considered in considering free cash flows. So why free cash flows, and what companies do with free cash flows, or what can businesses do with free cash flows, and when is it used? Now, free cash flows are, I think it's like diamonds, or it's like gold in your hand, that after all the capex and everything, you have free cash flows and you have a lot of flexibility to take calls on what can be done with it. So first, what you can do is, generally companies with free cash flows can go ahead in acquisitions of other companies with better ROC. If a other company has better ROC and it might boost the holding company's ROC, they will use those free cash flows in getting the acquisitions done. Second, investments in fixed deposits or mutual funds. Now again, if you have free cash flows, you will not keep it idle, right? You will put it in FDs, or you will use it for generating better returns. Thirdly, reduce your debt. So repay existing loans, whatever, because it's a free cash flow. So you are going to get much more benefit in reducing debt and reducing your finance cost going ahead. So reducing and repaying existing loans can also be done with free cash flows. Fourthly, I think this is pretty common, is pay dividends. So they give out dividend when they have free cash flows. They give out dividend, make the shareholders happy year on year basis. Or buyback shares. Now till 2 years back, dividends were getting taxed, but buybacks weren't. Probably in the last Finance Act or a year or they have also taxed buyback in the hands of the shareholders. So now the benefit of buybacks and not dividends goes ahead. First, companies should not give dividend, but probably buyback better, so that there are better returns for the capital returns for the investors. But I think now they both are in the similar aspects. Now, dividends are paid commonly, as I told you, but it is important to see if they are paying out of their FCCF. FCCF is free cash flows and not negative cash flows, only to keep the trends of dividends going. Now, you might see companies की dividend बहुत दे रही है, they're giving. That's okay. But as an investor, you should not be happy about only getting dividend. You should be happy about कहाँ से आ रहा है dividend. वो फ्री कैश फ्लो से आ रहा है या वो डेट लिया है 12% से और आपको दे रहे, देन इन लॉन्ग टर्म यू विल ओनली सफर. So there is no point in if you have no free cash flows and giving out debt. So that's a really important point investors to see, can not only take dividend but also analyze the fact कि कहाँ से आ रहा है वो. Let's see a wonderful case study on the next slide, which will give you much more clearer detail about what I'm talking about. Again, DMart, Avenue Supermarkets Limited. If one analyzes the cash flows for the year FY 17-18 and 18-19, cash flow from operations, okay, I'm talking about operations here. Cash flows are like here, like below. 17-18, there is 730 crores of cash flows from operations. I'm not talking about free cash flows, okay. I'm talking about cash flows from operations. So 730 crore of positive cash flow from operations. In 18-19, this has gone up to 806 crores. So this is really good because the operations are getting stronger. They are generating sales are generating cash better. Robust positive cash flows from operations for both the year, obviously. Now let's take into consideration free cash flows. Now you saw in the earlier slide what free cash flow means. Let's take into consideration for DMart, what does it mean? For 17-18, you can see 159 crores negative. For 18-19, this is jumped up to 619 crores negative. Now what happened here for DMart? Negative free cash flows. Now you might say negative free cash flow हो रहा है, but cash ऊपर तो क्या positive operating cash flows थे. So what suddenly happened with them? Now if you go a little deep, you can see net capex has gone up by from 1,200 crores to 1,700 crores. So there is a huge jump in capex additions. Now why this huge capex? Now going through the annual report of DMart, one would realize they do not lease or rent stores, rather buy most of them. So there is real estate capex. So entire stores, you can see additional stores in new thing, they are, most of them are bought by DMart. So that is why they are incurring cash flows. And also DMart never gives out dividends. Now you know the secret why. Obviously you do not have free cash flows because you need to have, you have goals and expansion policies in place. You are using that operations revenue from cash flow from operations for the expansion. So why will you give out dividend? No, it's much better to invest than to give out dividends. Now I just want to quote here as the great Warren Buffett says in his letters to shareholders, and I think it's a very important part here. Why give out money when you can reinvest in the business at a much higher return, beating inflation, and create wealth for shareholders? Now obviously if that is going to happen, why give out dividends and just make the shareholders happy by getting a slight bit of thoda paisa, big temporary money? Think about the long term, and then if everything is settled down, give higher dividends going ahead. So that is what is actually right, and that what I think DMart is doing much more in comparison. So you might also see Berkshire Hathaway, that is a Warren Buffett's company in which he's invested, or he's got a promoter holding. He never gives out dividends. It reinvests his dividend, if I'm not wrong. It reinvests for years and years to go ahead. Okay, now we go to fund flow analysis. I think we've got 2 to 3 slides coming up. That's it, then we're done. Fund flow analysis. What constitutes increase in balance sheet size? Now what does this mean signify? Okay, it signifies year on year increase and the size of balance sheet either increases or decreases. What are the reasons for that? You might see if you look at balance sheet size, that means I mean to say assets and liabilities are obviously equal, but you see year on year liabilities get increased, year on year assets get increased. What does it? What makes it? What are the components to it? Now, example, company borrowing huge amount of debt can also increase the balance sheet to a large extent. Obviously, if you borrow a large amount of debt, it will be sitting in your liabilities as well as be sitting in your current account in the bank balances if it's not used. So both your liabilities and assets go up. But is it really quality increase? if it is quality increase if the debt is not used in a good way. Now let's see a case study on the next slide. Again, DMart. Now you will say, "अरे DMart हमेशा करते हो." Fortunately or unfortunately, it satisfies my example criteria. So I've stuck with that and I'm going ahead because it's a wonderful example about every scenario here. Okay. So this is the balance sheet size and the little parameters about liabilities. So if you go to see here 1819 and Q2 1920, that is unaudited obviously. Balance sheet size has grown from 7,000 to 8,400. Now this increase in balance sheet has been up to 1,400 crores and percentage has been 24 and 20 respectively. What does this 1,357 crores of 1890, what is it in account of? What has generated that increase? If you go to see, the increase is on account of reserves. Now reserves have gone up, debt was not there that year, increase in working capital and other residual whatever are there, but the major proportion here is reserves have gone up. Now this is a wonderful sign for a company growing. The growth is on account of reserves and is not on account of debt. If you go to see Q2 1920, probably the debt is gone up, we saw in the earlier picture, because there are a lot of loans going up and they are doing expansion activities and so debt has gone up. That is the reason, but still reserves are pretty strong. Reserves are still around 40 to 45% of their growth, which I think is absolutely wonderful. Now what is on the asset side of it? Now we saw the liability side. What are the sources of fund? Now what has it been utilized for? Utilized for, again, to validate our conviction of last 3 or 2 slides, the net additions or increase has been in on account of asset to net additions to fixed assets. So most increase in the balance sheet asset size has been due to the expansion of fixed asset by owning leasehold land and building. So if you're going to see 1,357 for 1819 increase, 999 plus 229, the major 90-95% increase is invested. So the sources have been used to, application has been in the fixed asset and the capital WIP, and obviously others are working capital and inventories and so and so. So if what you can analyze from this is a robust balance sheet. But if a balance sheet is growing on account of debt or on account of creditors, it can't be sustained for long, and it's not going to make a lot of wealth for the shareholders. Or as an auditor, you need to be careful in putting out your remarks and qualifications, because over time this may lead into problems and this may go into problems going ahead. So coming into my second last slide, management analysis of companies. Now we all saw about the financial aspects of analysis of companies. I took this section primarily because we do not analyze management as carefully as they should be, and considering last many years whatever has happened with, say, ILFS defaults, what has happened with CG Power frauds and a lot many in place, managements were responsible. So you need to see what managements are doing. So what one forgets is, even if all the ratios, financials, everything looks good, if the management is not shareholder friendly or for an auditor having appropriate corporate governance, it spoils everything. It's no use and it will not sustain. So the growth that you can see year on year, everything you can see will not sustain. It will come to an end surely in some point of time. So how do we determine a good management of a company? There are many parameters, frankly, this is subjective but I'll just list down a few of them. A few of them list down is check promoter's background. I think Google comes into immense help here. Just put a promoter background. If you have got cases and frauds and this and that against him, Google probably won't lie. One odd article might lie, but a series of articles might not generally lie. Second, promoter's management remuneration. Now mandatorily to be disclosed in corporate governance report. Now this has to be compared year on year increase with financial business position. Now if the company is going to losses, they are not making profits for shareholders, or they are not generating free cash flows, and there is increase in promoter remuneration or management remuneration, it really doesn't make sense. Why are the management taking in more salaries or taking in more remuneration when they can't generate profits or they can't do good with the business? So it's over a period of time it becomes a red flag, and you just realize the fact that managements are not what they seem to be. Again, related party transaction, detailed scrutiny needed, but we'll get lots of insight about the management, about who the related parties are. Is it the daughter or the son of the promoter and his company, and they are dealing with it, and so and so and so. It's an entirely different story you can form through that related party. Warrants. Warrants are issued to themselves. Warrants are different from open market purchases of shares, and paid up terms are also different. So this probably a detailed discussion will be for some day, because I can't cover warrants. It's a huge topic, and a lot of complication stuff there. Also, some more parameters that I take into consideration: management focused on share price. See, the job of the management here is to do business. It's not to worry about share price. Share price is according to the focus of the markets and stuff happening, and multiple things. If the management is through its commentary or through its annual report trying to talk about share prices, it's not doing good, and over a period of time you just realize they're just doing it to keep investors happy, and they're not really doing it to keep the business working and going on smoothly. So that's a little bit of a red flag that goes into the picture. A consistent change in accounting policies does not look good if done on a consistent basis, on year basis. If you are doing accounting policy one odd year changes due to requirements of the business, due to some changes happening, it's okay. But year on year, if you are doing accounting policy changes only to boost some revenue, to reduce some cost, and this and other aspects, it doesn't say good things about the management. Now again, as I told you, dividends have to be paid out of FCCF and not raising debts. Now, if you are rising, taking in borrowings and going out dividends, it's a no. It's an absolute no for me for a company like that. Project execution skills and its comparison with management commentary. Now, last year annual report, for example, company might have said we will do this, and next year when you go to realize the fact that actuals it's not done. 1 year, 2 year, 3 years, it might be the case. But consistency is happening. That means they're just making false promises and not creating them into opportunities. So if it's just going to be talks and no work, it's not good when you analyze management, and you might as well skip the company at all. And that's what I've written here. So one of them can compare future implementation with the past assurances given by the management. Now this one is only for listed companies, obviously. Insider buying of shares through open market and holding the same for consistently long time. It shows the confidence that the promoters and the management have in their own business. If they have business, obviously you will not put in money if you are going to lose it. You know you're going to put money, and who knows better about the business than the promoter. If they're buying, in addition to multiple analysis, this is one of the analysis. What people make problems are, they just look at this and invest or take calls. You have to look at multiple positives and this one. Don't ever look at only insider buying and then go ahead and put in. It's not going to serve any purpose for a long time. So coming to the last part, it's really difficult times for the company, for the industry, for the economy as such. But what should investors and auditors do? I know there is a silver lining that this will come to an end, because we've gone through, humans have gone through a lot of stuff over the years and years, and आज नहीं तो कल ये खत्म होने ही वाला है. But what do investors, खत्म होने के बाद या खत्म हो रहा है, तो what do investors and auditors need to do? I'll cover the investors part first and then come to the auditors part below. Now watch out for companies who are market leaders. Why I say market leaders are, ideally they are the first ones to get back lost demand. Now because they are market leaders and is a reputed name, there is sluggish demand, there is no demand due to the lockdown. But once everything becomes normal, they will be the first ones to get back the lost demand, because they are already the leaders. Unless and until they goof up a lot in their plans and goals, but it should really work out. Again, debt free or low debt. Huge advantage. I think during the liquidity crunch situation times, I feel being debt free is like holding diamonds, and I don't mean it only on the slide. I really genuinely think it is, because at this time when there is no liquidity coming in, there is shortage of funds and everything. If you are debt free, you can use those funds and concentrate much better on taking a lot of decisions than being boiled down or to debt and making those repayments in time. Third, free cash flows. There is no obligation to use the fund. Management can use the funds to come out of this turmoil rather quickly. So if you compare company A and a company B, a company A having free cash flows will get out of it better than company B who is struggling to make cash flows work. So that will be a problem going ahead, because come out of it, at least it will take a quarter or two to minimum to come out of this. So it is better to concentrate on strong balance sheets rather than concentrate on P&L, at least for 2 or more quarters. P&L will get bad. It will, that is a fact, that's an open secret, but strong balance sheets will get you out of the bad or the worst times early. So that is what investors should focus on. Be very careful in analyzing balance sheet with respect to liquid ratios. I think current ratios, quick ratios, cash ratios would never have played a more important role than in this time. Over the years we just do it theoretically कि how much is the liquid ratio, okay solvent है ठीक है, but in these times it's really important to see which balance sheet is really solvent and which is bought down by the borrowings or the pressure, or there is a little strain in the balance sheet. Now for auditors, obviously in addition to above, and for auditors in addition to entire all the PPTs that is given, you all everybody obviously knows a lot more in their auditing standards and processes that we can do much more. But in addition to above these above parameters, what can you do during these times? Being careful during audit with revenue from operations, as management might go aggressive in meeting the budget targets, obviously, because everybody knows there is sluggish demand, so management may try to boost or make some accounting policy changes, or when the AS9 is not being compliant with, they'll still try to boost revenue and keep the margins afloat. So auditors have to be extra careful this time in auditing revenue from operations. Secondly, it would be most important to be careful with going concern qualifications and its judgment. Now, time to go back and refer ICA guidelines. Going concern, I think most of the not most, but some of the companies who are not strong in the balance sheets will face really troubled times in the times to come. So going concern, is it getting hampered? Is it not getting hampered? You have to take calls, and there are good guidance notes given by ICI over the times where you can refer and take calls whether the lost demand, no, the company is really getting worse or getting bad, and qualify accordingly. So that was my entire 1.5 hour. I think I've kept around 10 minutes or so for the Q&A. One disclaimer: whatever company I have used is only for illustrative purpose. Viewers should do their own analysis if investing and should not rely on the same. So stay home, stay safe. Let's get over this really fast and together. And I think if we follow instructions of the government, I think we should be getting past this and over this very quickly. I really want to thank the Pimprinchal branch of ICA for organizing a wonderful session here, especially the Vice Chairman C. Chandrakant Kale, Program Coordinator Pratima Bhise, Technical Coordinator Kiran Sonavne, C. Shailesh Bore, and all the Managing Committee members, because they have been very working hard in these times to coordinate with the speakers and get good sessions for all of you. So really thankful for that. So I'll just get back to the Q&A if there are any thing there lined up right now. So any Q&As coming in? Okay, I can see one question from Paresh Sancheti right here. He says, why is rising sales a red flag if it's a good thing? I said rising sales in comparison with rising debt and also rising receivable. So if you compare all the three things together, then it is a bad thing. Only rising sales, obviously, if you consider the first three parameters, they are obviously good. But apart from that, if it is all the three together, then I think it's a real red flag out there. So I think no more questions there. So I'd like to end this. Thank you so much everybody for viewing this. I hope it was worth your time, and I hope